Every investor should keep a diary. Articulating reasons for buying or selling, even to oneself, helps to highlight sloppy thinking. More importantly, it's all but impossible to learn from one's mistakes without a contemporary record. We humans tend to remember our successes and gloss over our mistakes. Now, short view's exposed to the merciless spotlight of FT viewers every day, and from time to time to the Lex team's Dalek as well. But memories are short. I'm leaving, but it's worth looking back at the lessons that can be learned from the mistakes and occasional successes of almost 6 years of pontificating daily on the markets. Now, since I started in 2010, there have been only a few short periods where investors weren't obsessed by central banks. Even in those unusual months, government action still dominated markets. The near default of the US government in the summer of 2011 and the incompetent state handling of the Chinese equity bubble popping this summer are clear examples of that. The US Federal Reserve's QE2 in 2010, Operation Twist in 2011, QE3 in 2012, and the taper tantrum in 2013 dominated world markets. That, of course, was interspersed with various forms of emergency action by the European Central Bank before it finally got serious this year and launched proper quantitative easing. Bank of Japan's decision to give it the full Zimbabwe filled the gap in between. Now, Shortview naturally shared the market's obsession. Where I had success, it wasn't due to greater insight into the likely actions of Janet Yellen, Mark Carney or Mario Draghi. Indeed, central banks' forecasts of their own actions have been pretty poor. Instead, it was thanks to a mawkish love of sentiment analysis, selling when the herd rushed into shares, bonds, Australian dollars or anything else, and buying when the last of the bulls had slunk back out, pursued by bears, mostly made sense and made money. Now, a contrarian streak's essential to successful investing, but sometimes the crowd is right. Shortview abandoned US shares far too soon, part of a failed focus on value, which also saw too early an exit both from this year's China bubble and from the Modi rally in India. In the long run, cheap value shares have solidly beaten expensive growth stocks, but not over the past 6 years. In fact, the growth style has beaten value every year in the US since the crisis, even including dividends. You can see on here the annual change, the 1 year change rolling in US value and growth stocks, the red line showing value. You can see there's really only this one period in 2013 where value did better than growth, and that was during the taper tantrum. Now, growth's outperformed overall by 11 percentage points across developed markets over the period. My last short view video comes as the Fed finally appears poised to raise rates next week, the first time in almost a decade. As Alan Bokobza at Societe Generale points out, this might lead to a renaissance for value if it feeds through into higher bond yields. Cheap shares have tended to outperform when 10-year treasuries rise and to underperform when they fall. On here, the red line shows the relative performance of value stocks, so they're beating growth when the line goes up and underperforming when it goes down. Against that, the blue line shows 10-year US Treasury yields, and you can see the two have broadly followed the same direction, with that period during the taper tantrum where value was winning, of course, being tightly linked in there to a very sharp rise in bond yields. Now, overall, of course, value's been underperforming now for a very, very long time, and that has tied in really quite tightly to the drop in bond yields. But before rushing out to pile money into the super cheap mining or manufacturing sectors on the basis that with the Fed raising rates, this 10-year yield's now going to head up, it's worth noting that this sort of pattern didn't really hold up very well in the 1990s. The only thing investors can be sure of is uncertainty. Catty markets have, of course, spent far too long showing cupboard love for central banks, meowing until they're fed by the Fed. Investor diaries are sure to continue to contain frequent views on Yellen, Draghi and Carney in the next few years as well. But hopefully a recovering economy will lead to the end of experimental monetary policies and mean that fundamental analysis again starts to matter.